In this video, I shared two dividend stocks that I just bought during the last couple of weeks. And if you're new to this channel, here is my current strategy with dividend stocks. I will link the full video here. So one of those stocks, the first one, is going to be not exactly using the strategy. It's a tiny position, and I will share and explain why in a minute. The other one is also a little bit unusual for me, but still wanted to share them and explain my rationale and just sharing my journey. So yeah, so let's go to the first one. So the first stock that I bought is Thesis Energy Corp. It's a pipeline. It's a Canadian pipeline, the second largest in Canada after Enbridge. It deals mostly with natural gas. It has a small portion in oil, which is it is about to spin off in the end of this year, I think in December. So it's gonna be split into two companies, but this is the major one. It's gonna remain, and I think 84%, something like that, of this the dividend is gonna remain also, and I will get a small amount of this South Bow new stock that is going to be the spin-off of the oil business. And then TC Energy is going to remain only in natural gas and electric utility. So again, this is a pipeline. It's not a limited partnership, which is nice because most of the pipelines are MLPs. So it's nice that it is not for whoever is not in the United States or whoever doesn't want to deal with all the forms. So we see that TC Energy has been growing its earnings long term, not as steadily as some of my other stocks that I bought using my strategy, but still we see it is growing long term, and it is right now estimated to continue, both by the management and analysts, to continue growing long term about 7%, which is a lot. So even if we don't necessarily take that into account and take a more conservative growth rate, it's still nice. It has a BBB plus credit rating, and it has a really high debt. Currently it has a really high leverage ratio even compared to its peers, which anyway, all those companies have really are really leveraged, and they're very capital intensive. So it has a plan to deleverage in the next few years. Its capex is supposed to go down in the next quarters, we shall see, and to free up some cash flow for paying out debt and lowering the leverage ratio. So, but it's gonna take a few years, at least a few years, maybe in 2026 and 2027, they will be able to get to a more normal leverage ratio. And that's maybe the biggest risk with the stock, and might be why it's trading lower. It has really underperformed the other MLPs. So in terms of the dividend, it has been growing its dividend for 24 years now. So this year it's gonna join the Dividend Aristocrats Club, which is nice. You don't necessarily see that here because of foreign exchange between the Canadian dollar and the US dollar, but in Canadian dollars it has been growing for 24 years now. The payout ratio is really good, it's nice, nothing wrong there. And the dividend seems really safe, and it's 6% now, which is really nice. Historically, obviously it's a high yield. Historically, if we look at this is a yield in the last 10 years, we see it's not like it's a crazy opportunity. We had a better opportunity already lately, and unfortunately I missed that. I hope for you you did not, but still 6% historically looks good. It might go, I will explain my rationale for buying it soon, but if the stock goes down and the yield goes higher again, I will add more, but it might also go up, and I will enjoy it with my small position. So in terms of valuation, if we look at this graph, it looks like TC Energy is a bit undervalued, because it not a bit, it looks really undervalued because it has been trading historically at a 17 multiple, but it's not exactly, because we see that it wasn't really stable in the past also, and it's not like it's always have been trading around this blue line, but also we see that since 2018 it has been trading at lower multiples. So if we shorten the horizon a little bit, we see that the normal multiple is much lower, even lower than the 15 normal multiple. It has been trading around this 13 and a half. So in that term, the current PE of 14 seems really fairly valued, even a small over, but we don't see really an upside here, and that's why I've placed a really small position in it. One of my smallest position, just to lock in that 6% dividend, because it could go again higher and the dividend will go lower like it has been historically, especially with the interest rates which seem to are being lowered now. So just to lock in the dividend, it's a tiny position. If it goes down, then I would add more because it's gonna have an upside. If it goes up, I'll of course enjoy it, and if it goes of course to those valuations again, I will probably sell. And if it goes sideways, meanwhile enjoy this 6% dividend, which is really nice. It's a nice addition to my portfolio. I currently have 3 stocks which have higher yield, and they are higher quality, and they don't have an upside. I hold them, the 3 of them, with the same mindset that I do collect this safe, nice dividend in the meanwhile. I will certainly add more when they go down, but if they go up, I will sell, and if they go sideways, I just enjoy the dividend. So those are now TC Energy, Conagra, and Pfizer, which I both did videos about both. So if we look at the cash flow, just to show, it's pretty much the same story, where we see it's been trading more around its cash flow. So we've seen more of a volatility in the multiple in the earnings, but in the cash flow we see it was trading pretty steadily around the blue line. So even maybe that's even a better indicator than the earnings. So we also see that right now there is no real upside. It's right about fair value currently, maybe a little bit even over. So yeah, it's just a small position. Like I said, for now I feel it's really safe place to park my cash. I didn't mention the really high safety of TC Energy, where 97% of its revenues, of its EBITDA, is from regulated and long-term contracted revenue. So it's a really predictable and safe investment. Not a great opportunity in terms of returns, but again, a tiny position. I would gladly add more when it goes below the blue line. I will enjoy it when it goes above, and for now, if it goes sideways, there is still like a little bit of an upside, not really. So that was the first stock. The second stock I bought lately is Realty Income, a REIT. Now, I don't want to get in a whole discussion about REITs. I feel I could talk for like 3-hour-long videos about the pros and cons and the risks with the REITs. I might do that, maybe not 3-hour long, but overall I kind of avoided REITs during the last few years. Overall, I'm not a big fan. But my largest gain until today was actually in a REIT, in Simon Properties, SPG, coming out of COVID in 2021, when I did employ this strategy that I'm doing now with a lot of dividend stocks. And my largest position was SPG, and I did really well with it. I was up like 60% with it. So I kind of have a warm place in my heart for it. But during the last few years with REITs, with interest rates higher, obviously, they were both just as an alternative, as a cash cow alternative to bonds. They were trading lower, and they had much bigger risks, where they are highly leveraged, although both Realty, and I didn't mention, but TRP also have most of their debt in a fixed rate, but still it seemed a little bit risky risky for me. And again, I could talk about it for hours, but also the value of the properties themselves are lower when the interest rates are higher because investors are seeking higher returns. So I kind of avoided the REITs until now, but now I am shifting my strategy a little bit, and I'm shortening my horizon a little bit, and it's just something very specific I do. And for that purpose, Realty Income could really fit it well, because we see this graph where it's growing its adjusted fund from operations really steadily. And of course, it's a REIT, and it's a little bit different than a company that is growing its earnings this steadily. But still, out of all the REITs, it seems like Realty Income is really top notch, one of the highest quality ones. It has a minus credit rating. It has really high quality tenants, which the largest of its tenants are Dollar General, Dollar Tree, and Walgreens, which are struggling. And then this is probably one of the reasons of the stock being trading lower. But I think the largest reason is the interest rates. But still, none of its customers comprises more than 3% of its funds from operations. And overall, the portfolio of the tenants is really high quality. It has and it's pretty diversified. It's mostly in retail, but even in the retail space, it's very diversified. It's diversifying internationally also. It has like 10% now in the UK, and big European brands like Tesco and Decathlon and Carrefour, and also in the United States, it has really big names like Walmart and a lot of them. So a really high quality company, a high quality REIT. It does seem to use more of its own cash. I mean, it still issues shares and debt. Obviously, it is a REIT, but it has a potential to use more of its cash to finance its growth, which is amazing for a REIT. It is, in terms of the dividend, the current yield is 5.2%. It's, we'll look in a minute, it's in a higher range, obviously, because it has been trading down. It has been growing dividends for 29 years now. It is a dividend aristocrat. So really high quality. We've seen it done pretty fine, just flat during the financial recession, which was obviously around the real estate. So that's nice. Let's look at the dividend yield for a minute, and then talk about valuation. So again, we see that similarly to TRP, I kind of missed the bottom, missed the great buying opportunity. We can also see that here. I mean, I wish I could buy it more here, but I did place a moderate position in it, and I'm always willing to buy more if it goes down again. Still, there is some upside here. We will see that. We already see that, but we will talk about it in a minute. So in terms of the dividend yield, it's not great. It's not the best opportunity, but it is higher than it's been. I think it's unfair to look at it like that because of interest rates that are so much affecting it. But still, 5% yield is fine, is nice. It's I feel it's a good opportunity to catch 5% yield from Realty Income. So in terms of valuation, obviously the biggest reason for me to invest in it is the upside. So it's a bit complicated, and it's a bit not a clear screaming buy because again of interest rates. So we've seen that since the financial crisis, it has been trading around 17 PE, but it has been pretty volatile when there were times where it got really to high valuations of 24 of AFFO. It seems really richly valued, but of course it was a zero interest rates environment, so we shouldn't expect that now. We don't know if and when we get to those interest rates again, so I'm not counting on this. But interest rates are being lowered finally now, so we might gradually see some upside in it. But even if not, I still think because the price has been volatile, because it's such a high quality company, I think that even with current interest rates, we will see the 17 valuation again because of the volatility. I feel like I'm almost a technical trader now, but it will eventually get there, even if slowly but surely. My price target is around the 70s, around maybe $70. That's the point where I sell. I believe we will get there in the next few years, and if not, in the meantime, I collect this monthly, not that I care, but 5.2% dividend, again, super high quality. So this is a moderate position in my portfolio because I do think there is an upside here. Looking at funds not adjusted, funds from operations, we see a similar story. Yeah, I think there is definitely some upside here, a little bit. So if we go back, yeah, from the current price, I think I bought it a little bit lower, but it's still 25% upside, maybe a little bit less, maybe 20% upside, plus the dividend in the meanwhile. I like it. It's nice. It's fine. Not my highest conviction. If you want to see my highest convictions, you can watch my video where I reveal my entire dividend stock portfolio. But yeah, I think it's a nice addition to my portfolio, some exposure to real estate. So yeah, so those are the two stocks I bought just recently. It's been a brief video, no presentation. I'm kind of doing a mix now. Let me know what you think of this format of a video. So, and about the investments, obviously, please write anything. I would love to hear any feedback about the quality of the video or the content itself. So yeah, so I'll see you in the next one. Bye bye.